With credit spreads, you're either using 2 calls or 2 puts and have the same expiration date, but they've got different strike prices. And what you're going to do is you're going to write one that we call the short. You're going to sell that to somebody else, and you're going to buy the other. That's the long. And what you're doing there is hedging your risk. In theory, you could just write an option, sell it to somebody else, but you have a theoretically unlimited risk if you do that. So it's a very dangerous thing to do. You also buy that other as insurance that if the one that you wrote goes into the money, you can cover your liability by exercising the option that you have bought. Now, the golden thing about these, at least from a psychological standpoint, is that you always start with a credit. In other words, you actually get your maximum possible profit on day one. The minute you do the trade, the credit goes into your account. And the reason this happens is that the option that you're writing or selling is going for a higher premium than the one that you're buying. So the difference between those two things is a credit that goes right into your account. And there isn't any other investment I know of, really, where you actually start on day one with your maximum possible profit. And then the whole point of strategy with credit spreads is to get to hang on to that profit that you booked on day one and not lose it. You do have to have a cash margin in your account to do this. The maximum theoretical loss you could have with a credit spread would be the difference between the 2 strike prices less the credit that you've received. And the reason that's important is that your broker will insist that you actually have that much cash sitting in your account to cover the trade, and it's got to be there for the duration. In reality, if you're using an appropriate exit strategy, you would never suffer a loss that big. But it's a theoretical possibility, so it has to be there. Now, the objective is to have these options expire out of the money, expire worthless. If that happens, you get to keep the full credit that you received on day one. And you would also have the choice of closing the position before expiration, and in that case you would get the original spread that you received on day one minus whatever the spread is on the day that you close the position. You're making some kind of a directional bet with a credit spread, but it can be very broad. A so-called bull put spread is 2 puts. You're expecting either a neutral market or a rising price, and therefore you sell puts because, again, remember, you want them to expire worthless. So if you think prices are going to go up, you sell puts. And the opposite is a bear call spread with 2 calls. If you think the price is going to be neutral or falling, then you sell calls. Again, because you hope that those calls are going to expire out of the money. Third possibility is to do what's called an iron condor. And this is both a bull put spread and a bear call spread at the same time. And you would do that if you really expected a neutral market, if prices are just going sideways. And that's even better because if that happens, you actually collect 2 credits, one on the bull spread and the other on the bear spread. And if the price stays neutral, you bank all of that at the end.